when you look at the stock market reaction relative to the dollar and the treasury bond market reaction, it seems like it was clearly more of a risk-on mood than it was a peace dividend kind of mood. You know, if there was a safe haven bid to the US, it was pretty feeble, I guess is my point. You know, when you look at the dollar and treasury yields, they basically barely moved. So it seemed more like a risk on, and maybe that was a function of the fact that the oil market, as you said, rather than being $80, which is what I sort of expected we'd wake up to Monday morning, actually went down. So I think maybe that was it, because obviously if you don't see higher oil prices, that's tremendously supportive for risk assets in terms of lowering presumably the second largest cost to businesses outside of labor. That might be it. It could just be, you know, trying to put a positive spin on things. But I do think that in the broad sweep of things, what we've seen is a move by the administration that continues to burnish this shift from the sort of, let's say, globalization move to more of this mercantilist agenda. And that being because essentially, in addition to kind of blowing up this situation between Israel and Iran and kind of forcing a peace accord, I think that action, that very aggressive, strong action that the president took over the weekend, sends a signal to Russia and China about any of their malign intents, you know, that the U.S. isn't just going to stand idly by, and that, you know, we're going to take bold action when needed, even though our impulse is not to put boots on the ground anywhere around the world. That doesn't mean that the U.S. is just going to sit back and let China and Russia and other bad actors run roughshod. So that might be another aspect of this that's worth keeping in mind, especially as we move forward in, I guess, 2 weeks, have the BRICS Plus meeting where Russia and China obviously will be a paramount in discussions about the further growth and expansion of their trade relationships and their move toward developing a joint currency or trading currency. So, you know, I'm kind of stringing together a lot of thoughts there, but I do think there is some connection between our national security action and what it means for this whole de-dollarization, globalization theme that we've been talking about every other week now. Another big moving part is the shifting expectations around the Federal Reserve. And I think that's really important. You know, now that there's more chatter about a July possible rate cut, whereas previously everyone was thinking maybe September, possibly for the earliest. And now we've got 2.5, let's say, Fed governors coming out and saying, you know, we might actually have the rationale to move sooner, as soon as July. So I think that's obviously a huge support under the markets if it looks like the Fed is going to be a little bit more accommodative. But I continue to believe that, you know, Powell, this is really not about the economic data for him. This is about showing that he has the stones to stand up to Trump and that he's not going to get pushed around, because the case for the Fed to be cutting rates today is better than it was in September. You know that I'm not an advocate for the Fed intervening in the markets and trying to set interest rates that the market should be determining, but this is the world in which we live. And if they're going to do that, certainly the rationale for doing it now is much stronger than it was in September. And I think it's not for nothing that the bond market slapped the Fed across the face when they started cutting rates in September, because it was so nakedly political. And again, you know, there wasn't really the economic justification for it. So the bond market vigilantes said, look, we're going to reverse any stimulus you're trying to inject into the system by exactly offsetting the drop in the Fed funds rate by driving the 10-year yield up in equal measure. So we'll see if that happens this time around. I suspect that the bond market probably won't sell off the way it did then, again, because the backdrop is more dovish. But I wouldn't expect to see a dramatic rally either across the Treasury spectrum because of our fiscal situation. And that's another aspect of this Middle East situation and our involvement there. It certainly puts paid to the idea that we're going to have any reduction in spending, as particularly as relates to one of the biggest components, which is defense spending. if inflation is definitely decelerating and the run rate is even slower, and we're clearly seeing some weakness on the employment side, and those are their two mandates, yeah, I think as ever, Trump will be right for calling Powell too late in his, definition of too late. I mean, clearly the slowdown is really in train. We just got the Duke University CFO survey out. And again, it was a very downbeat assessment from CFOs about the uncertainty. And they're very concerned about tariffs and the impact it will have on their margins. And so they're really restraining CapEx and by extension, hiring. So, this is an environment where I guess, if you're a proponent of Fed, intervening, then this would be the time for them to do it. But I do think, yes, Powell will probably dig in his heels just from an egotistical or political standpoint, either way, at a time when the case for cutting is certainly stronger than it was when he was cutting. I'm just comparing today to when Trump did tariffs under his first term. And the backdrop then, first off, the economy was stronger. The global economy was stronger. So the countries upon whom the tariffs were being imposed were in a better position to just let those tariffs ride and get dealt with on the U.S. side of things. Today, that's not the case. I mean, I think one thing that's really clear is that prior, in the first administration, that all unfolded prior to the 9% spike in inflation. So household budgets had not yet been eviscerated by this massive ramp up in inflation related to the COVID stimulus extravaganza. And that really ravaged low and middle income household budgets, and we're still dealing with the consequences of that, as evidenced, and we talk about it every other week, by the soaring delinquencies on credit cards, auto loans, and now student loans. So the wherewithal for consumers to absorb these tariffs, if they were to be passed along, is so much lower today than it was during Trump's first term. And I understand that the tariffs back then weren't as broad. They're kind of unilateral now, whereas back then they were fairly targeted on specific countries and items. But I think that this idea that the tariffs, it's a tax on consumers and they'll pay it, is just overly glib. Go back and look in 2018 when they put the tariffs on, the PPI went from 3% to 1.5% over the next 12 months. And the CPI went from, I think, 2.5 to 1.9. So inflation, both at the wholesale and consumer level, actually slowed after the tariffs. And that was because the rest of the world absorbed them on their end, especially China. And again, because the global economy is in a weaker place, I think if their inclination was to do that last time, it'll be higher now. But even if they do pass them on, I think there's a brick wall as relates to the consumer and his ability to absorb those. And the student loan thing is a major factor in that calculus because, as we've talked about prior, and I guess yesterday, TransUnion reported record delinquencies on student loans. I mean, they've been tracking this since 2012, so the history isn't centuries or anything, but it's long enough to give you the sense that, like credit cards and auto loans, we're probably seeing the worst credit situation for consumers since the global financial crisis. Yeah, absolutely. I mean, I think the issue of servicing the debt is certainly crucial, but think about the amount of marginal consumption that is siphoned away from spending, into service of debt. So we lived in this sort of fantasy world for a long time because of the suspension of the student loan payments, where consumption was very strong relative to what it otherwise would have been had they been forced to be making those payments. And now we're going to discover just how much weaker spending would have been. And that's another thing as relates to the case for the Fed to be cutting rates today. I went back and looked. When they cut in September, the Atlanta Fed forecast for the near-term GDP had the consumer spending component at 3%, or 3.6 was the number, which is incredibly strong. Today, their near-term PCE forecast for the near quarter is 1.8. So it's half the pace that it was back then. And we're still, I think, if anything, that's overstated because we're just starting to see this hit in spending from the student loan thing, but also the give back from the tariff front running. Don't forget about that. We had this huge surge in retail spend going into the tariffs on the panicked expectation that, you know, your car price was going to double and your washing machine price was going to double, so you better buy it now. And we've seen a pretty significant give back, at least as I look at the weekly retail sales reported by Redbook since then. So clearly we're going to see a pullback in the consumer spending numbers, and that again should be a strong case for the Fed to be tilted more dovish, because it really calls into question the capacity of consumers to pay higher prices. You know, generally slowing spending is not an environment where inflation is moving higher, quite the contrary.